Who stands to be the biggest loser if free trade starts to unwind? Who stands to gain? I'm Harrison Beck, FS Investments Content Strategist. It's been a wild few weeks, with evolving trade policies sending markets into wild volatility, and investors are looking to prepare their portfolios for what's happening now and what's likely to happen next. Luckily, we've got FS Investments Chief Market Strategist Troy Gayeski here to make sense of it all. This is The Takeaway with Troy Gayeski, a podcast from FS Investments. Welcome, Troy.
How are you, Harrison?
I'm doing good. Where are you recording from today?
Actually, our home studio office in Connecticut. So very excited to be with you all and looking forward to a lot of good content to get through.
Sounds good. Well, let's get into it.
Yeah.
Troy, you've outlined two really useful frameworks for understanding the current tariff-inflected environment, and both can be found in your two most recent strategy notes on fsinvestments.com/insights. One is the Keynesian formula for GDP, and another is a term you coined with a name that truly communicates the cosmic gravity of today's tense economic landscape, and that's the Galactic Mean Reversion. So this is a concept you first gave investors in 2022, and now, as you say in your recent strategy note, it's back. So what is the Galactic Mean Reversion, and why do you call it that?
Yeah, so if you look at the chart that you see in front of you, what you can tell is that U.S. equities, represented by the S&P 500, again, market cap weighted, the largest, greatest companies in the world that are principally based in the U.S. and traded on U.S. markets, has had outrageously better performance than even corporate profit growth, which has been very, very good. And we'll get into that more. And certainly many orders of magnitude higher than we've seen nominal GDP growth, the real GDP growth, or even money supply growth. And so, the whole concept of Galactic Mean Reversion we came up with, late 21, early 22, because two of the most powerful forces that drove that outrageous outperformance of U.S. listed equities relative to nominal GDP, growth all starts with nominal GDP. Fortunately, U.S. has been the place to be for quite some time, relative to real GDP, and particularly relative to the labor market, where you see on the chart, wages are really only up about 20% in real terms since 1990. Hence, we're in the political moment we are today. So two of those forces, the first was money supply growth. So for years and years post-global financial crisis, or I should say during and post-global financial crisis, money supply growth was growing well in excess of nominal GDP because the Fed injected liquidity through quantitative easing programs. And then that was capped off by kind of the mother of all QEs during the pandemic. That provided the liquidity to drive all assets higher, financial assets, real assets, think real estate, commodities, gold in particular, crypto is an example. And then additionally, the second powerful force was we had a 40-year bond bull market where interest rates went lower and lower and lower. And that not only lowered the debt service costs for borrowers, including corporations, but also provided the intellectual justification for why an investor would pay more and more and more for every asset based on discounted cash flow modeling. And so what happened in early 22 is the Fed started to hike rates aggressively at the fastest pace in recent history, and went from massive quantitative easing programs to very aggressive quantitative tightening. Is those two forces that drove that outperformance started to drive tough performance and a really bad bear market for both equities and fixed income, which is one of the unique things about 22. But we say mean reversion for a reason, right? The other side of that was nominal GDP was soaring. We saw nominal GDP periods 8-9% type growth, which just is not usually a thing in the US. If you're growing at 1.5% and you have 1.5% inflation, nominal's 3. So getting to 9, not only do you have strong growth, but you also have very strong inflation. And then, that led to a really tough bear market in 22. And, we bottomed out and earnings, the economy were strong, and, the AI boom started, and that drove another big leg up in equity markets. Now you fast forward to today, and this is where we can reapply that concept to the price action we've seen since the tariff war started brewing in February and really went into overdrive, unfortunately, in April with the poorly coined Liberation Day term that our presidents used to describe when he reacted to the tariffs on like every one of our friends and enemies simultaneously. And so if you think about a third force that helped drive that tremendous outperformance, it was really corporate profit margin growth. So if you go back to 1990, S&P profit margins were about 5%, and they grew recently to somewhere in the 12 to 13% range over the past several years. So you had margins, which again, think of that as earnings divided by revenue, grow more than double over that time period. And when you think about the forces that drove that, one of the most important was globalization, right? The ability to outsource labor, the ability to tap into China in particular, but not just China, the ability to drive more efficient supply chains. So, depending on the analysis, that drove about 30 to 40% roughly of the corporate profit margin expansion. And so if you go back to the chart, you see obviously the S&P skyrocketing up over 3,200%. And then the next biggest growth was in corporate profits, right, by about 950%. And so what's happening now is you're calling into question and really reversing that whole globalization benefit in a very rapid order. And that's one of the reasons you've seen, first of all, coming into the year, it was kind of a goofy estimate, but bottom up estimates were like 13 to 14% S&P growth. I wrote at the end of last year, like that was going to be really hard to achieve for a variety of reasons we won't get into here. But you've already seen analysts cut estimates to have negative growth this year, which that would entail the continuation of tariffs, which hopefully will not be fully implemented. Obviously there's a 90-day holiday, but it's really important for, I think, from a framework of understanding what's going on, that, this is a 30, 40, actually an 80-year process since the end of World War II that's attempting to be reversed at basically light speed. And that, unfortunately, is what's led to this, very severe correction, mini bear market, and has every market participant on tenterhooks right now.
Well, and you say mini bear market. I mean, what was happening in 2022, and what can that tell us about what might happen now in 2025? Yeah,
so look, I think just to step back again, we don't want to seem to be overly bearish. We're just calling balls and strikes here, right? In that this is a potential mortal blow to U.S. multinationals if these tariffs are actually fully implemented, which we all hope they are not. And there's some, rationality that comes back. We totally agree that perhaps China should have higher tariffs for not only economic reasons, but also, national security reasons. But, Canada, maybe not as much, UK, we like to have allies globally. That's kind of a good thing geopolitically. One would argue. So the point here is that, in 22, you had two very identifiable forces going against you that had benefited you as a listed equity investor for quite some time. And now you have another very powerful force that you had benefited from over basically your whole investment career that is reversing very, very rapidly. So, we already had, mini bear market in the NASDAQ and the S&P. You've seen a strong, what we do think, unfortunately, is a bear market rally recently with some of the rolling back. But we're also, and we'll get into more of this, like there are now right tails in markets where things can turn out really, really well from this starting point. And it's just going to be a choppy, uncertain time. And, as you know, on media about 8 weeks ago, the main point I was making prior to things getting really ugly is this is really the first time you had a president of the United States and his Treasury Secretary openly saying they were willing to risk not just a bear market, but also a recession in order to achieve their trade policies. Completely new thing. And that's what led to some of the selling pressure, in March. And then once the tariffs were announced, it was kind of look out below because, as people looked at great U.S. multinational companies, as an example, Apple, their whole business model just about blew up overnight. right? Like, and fortunately, they've been given a reprieve. Hopefully that sticks. But just a very different environment.
Well, and we're going to talk a little bit more about who stands to benefit in this environment, who might be resilient, who is going to see some more challenges. I do want to call out the fact that we're doing something a little bit different on this podcast today. For those of us watching the video version of the podcast, we've brought up a great chart from Troy's recent strategy note. We're going to bring up some other really great charts and tables to look at. This chart warms my heart especially. It's got the great understatement of the year, maybe title, Galactic Mean Reversion Part 2, Trade Wars Are Sort of Bad for S&P 500 Profit Margins.
Yeah, the sort of bad, obviously, is tongue-in-cheek. I mean, if you go from, again, admittedly, like 13% growth was probably not going to happen, but, let's call it high single digits to maybe low teens if everything worked out well, to an environment where you could actually see earnings decline this year. That's a really big shift. And the other point there is it just was so beyond expectations, right? Everyone was super bulled up, thought you'd get, the TCJ extended, thought you'd get some deregulatory effort, really, there's a lot of optimism in markets. And then very rapidly you went to near peak pessimism. Obviously the pandemic was somewhat similar, much, much worse from an economic standpoint, very rapid onset. But that was, I suppose, in theory, man-made. But this was a choice, like a policy choice that was implemented by, obviously the most powerful economy in the world that just has very far wide-ranging effects.
Well, and speaking to those effects, let's get to our next question about who's going to see challenges, who might show some resilience. For this question, I want to ground us in two facts that you referenced in your strategy note. First, that mega-cap multinational corporations have meaningful dependence on foreign revenue. This isn't really new news to anybody. Typically, around 40% of the S&P 500's revenue comes from outside the U.S., and in many cases also they have non-U.S. sourced inputs, costs of goods sold. Compared to that, the U.S. middle market private corporate entities generate 84% of their revenue from domestic sales. So that said, let's get back to that question that I started this episode with. Who stands to be the biggest loser if free trade starts to unwind? Who stands to gain? And how can investors think about these macro movements when they're making allocations?
Yeah, so from a kind of biggest loser standpoint, it's very clear that our trade partners lose big time, right? And right now you have this kind of technical rotation of assets being pulled out of the U.S., dollar being sold, treasuries being sold, large liquid equities that had been sold to rotate into Europe and Japan and all this stuff. And that's great. I'm not saying that's dumb, but like if we grow at 50 basis points this year, like Germany will certainly have a recession. Like there's no doubt about it, right? Japan's going to struggle. You think of a lot of these poor emerging markets, and I don't see poor just in terms of income, but also just the way it could devastate their economies. I'll look at Vietnam as an example. I mean, their wages are 6% of U.S. wages. Like, what are they going to buy from us, right? Like, are we going to sell them data centers? Like, I mean, I guess we can sell them the capacity to store data in our domestic data centers, but it's really hard to make a case where the U.S. barely skirts recession, has recession, and the rest of the world that is trying to sell us their goods at much higher prices doesn't have, catastrophic damage. So that's obviously a clear loser. And then if you think of from a corporate standpoint, from a security standpoint, from an investable universe standpoint, it's really, and not just U.S., but given that U.S. multinationals make up the bulk of the market cap in the world, it's really U.S. multinationals. Because, if you're getting 40% of your revenue internationally, and as an example, not picking on Boeing, they're going through a tough restructuring already, and then suddenly the Chinese won't take their planes, right? You look at someone like Meta, a lot of the big cap tech companies have been admittedly and understandably quiet about what the impact would be, but some of the analysis would point to they could lose $7 billion of revenue. And that's where, over half of the revenue growth has come the last 2 years is China, right? So 164 billion revenue, you lose 7 billion. Like that's not revenue growth anymore. Now you're talking about revenue declines, which for a growth company is kind of not a thing typically. So, you think of U.S. multinationals, it's not just the sentiment, it's not just the price action. This is a potential dagger in the heart to their business models. And as I alluded to before with Apple, I mean, when you've spent decades building these production lines in countries like China, there's no possible way to move that production elsewhere in any time horizon that matters, let alone the cost of doing that after the fact. So, again, not being overly pessimistic, the administration has been making a lot of noise the past 3-4 days, which has led to a rally of rolling a lot of these more draconian measures back.
Well, and speaking of silver linings, I think there are a lot of investors who are seeing cheaper equities and they're saying maybe this is an opportunity for me. So what do you say? Are equities cheap enough to aggressively increase your exposure?
Yeah, so that's just be careful, right? I mean, that would be our message, right? Like everyone has a different, if you're an 18-year-old or a 23-year-old, or we've met with clients that, and news to me, they hadn't really invested at all since the pandemic and built up huge cash hoards and just felt that, look, this was a man-made problem. It can be solved. And I'm getting a much better entry point than, coming into the year when bullion was high. But just to put some numbers around it, I mean, if earnings actually hit the 10% expectation, and some would say it's down to 8, but bottom up through FactSet's still roughly 10, the multiples have compressed about 2/3 of what they compressed in 2022, to put it in perspective. So if this issue gets rolled back, then you're getting in at a relatively cheap entry point compared to recent history. However, if it's not resolved and the president really digs in, you've effectively, and earnings are flat to negative, you've effectively had no multiple compression, potentially even multiple expansion. So I think it's not, everyone has their own situation. I think most institutions are looking at it saying, hey, we've been overweight the US for a while. Let's peel off a little bit of that. If you look at the US, we still have the greatest companies in the world. We've talked about many times, though, those are mainly the large mega cap companies that, are really most impacted by this. And like the Russell 2000, for instance, is a really adverse selection bias index. So things have cheapened up if we have an optimistic outcome, but they certainly haven't cheapened up if we stay in a protracted trade war. And I'll tell you, one of the things that worries me the most is, you have China, the second most important economy in the world, and the U.S., the most important. And we're saying that we're talking to them, and the Chinese are saying we're not, right? Like what's going on, right? And that's a bigger part of what we talked about last strategy, is it's not just the policy implementation, it's the uncertainty it's causing. And you see in consumer confidence today, you see in business surveys, like CFOs think like guaranteed recession, right? Like one survey said 60%, but most of them, think it's more guaranteed at this point. And that is not certainly the case, but uncertainty freezes up economic activity. Uncertainty is the enemy of economic growth. So we're just hoping for a resolution relatively rapidly.
Fair
for
enough.
the sake of those that have too much beta.
Right. Well, and investors are going to have to consider uncertainty itself as a factor on top of or alongside of the actual ramifications of actual policy changes that stick.
That's right.
That said, you alluded earlier to potential right tails that investors are aware of or should be aware of. I mean, what are they?
Yeah, but even before we get into that, because we talked about U.S. multinationals, when we look at the mid-market in the U.S., because you cited their sales statistics, and
sure,
look, we're not Pollyannish, right? We've had conversations with clients and advisors who have clients that, their whole business model was based on importing cheap stuff from China and marketing and branding. So there will be sporadic pain, no doubt about it, if these policies stick. But in general, the U.S. middle market is very insulated from all this, given the heavy sales focus on the U.S., The U.S. is a service economy. A lot of the opportunities in the mid-market are focused on domestic growth, like data centers or software. One of the things that hasn't probably been highlighted enough is most services have been excluded from these the tariff uncertainty so far. So we're not sitting here saying there's going to be no impact to the U.S. middle market. Of course, there's going to be some, but there's also some percentage of companies that will benefit because their principal competition is from China or in some cases Japan. And as more domestically oriented entities, they really sink and swim more with, does the U.S. economy grow or not? It's much harder to grow revenue and earnings when the U.S. economy is not expanding because it's all about growth. And if you're primarily domestically sourcing inputs and you also have competition from overseas, you could end up being a winner from this outcome. So net, I think when you look at private corporations, those that are not directly exposed to input costs that have gone up, the biggest concern is, does the U.S. slip into recession or not? Right? Because I always, we don't have the chart, but if you look historically, middle market private companies have generated typically 1.5 to 2.5x the revenue growth or nominal GDP growth. So nominal GDP is at 5, revenue growth somewhere between 7.5 and 12.5%. Last few years, because we've had such strong nominal GDP growth, it's been around 12 to 13. We always expected that to go down, but it certainly could go down more. Think, 3% nominal GDP growth, 8% revenue growth. Still a good number. But if you start getting into -1%, -2%, which is hard, nominal GDP very rarely contracts because it's real plus inflation, then, it'll be much harder to deliver the growth that investors are counting on, at least from one part of their portfolio in this very uncertain time.
Well, and if investors are looking into their crystal ball and trying to figure out how long it will take for the damage from this new trade policy to be repaired, how does that affect their allocations, especially if they are starting to think about, well, maybe domestically oriented companies could offer me some kind of complement while things are a little chaotic?
Yeah, some solace in the storm, or maybe solace. I never could quite pronounce that word correctly. But you're better with words than I am, Harrison. But what's interesting is, back to use cases, I think, we've been articulating for 2 years, the Russell 2000, over 40% of the companies don't make money in a 5, 6, 7, 8%, 9% nominal GDP environment. That's not good, right? A lot of people think the Russell was cheap because some of the indices that are the way they're reported, they exclude the companies that don't make money. But if you actually looked at where it was trading coming into the year, it was 20 times forward earnings on earnings estimates that were pie in the sky, and 17.5x EV to EBITDA. So that's been a powerful use case and still is, replacing or complementing your U.S. small cap with mid-market private equity. And the other, it's look, a lot of advisors, clients have probably had too much international exposure for whatever reason. And, you've had this relative outperformance the last 3 months, which is really more flow driven, right? It's more flow driven. Money's fleeing the U.S., it's got to go somewhere. And now is as good a time as any. If you had 10% and you're gee, I wish I had 5, that probably makes more sense given all the global dynamics at play. If you're going to trim, now's as good a time to trim as ever because you're getting a better relative exit point than you would have coming into the year.
Well, zooming out from allocation to thinking a little bit more about the economy, what's maybe coming down the pike, you've pointed to some U.S. consumer and U.S. banking system metrics. We'll pop them up on the screen for our listeners who are watching the video version of this podcast. Looking at these metrics, are we headed for a bear economy? And if not, why not?
Yeah. So you think about it, it's a recession, right? So you have bear markets, recession. The main point of that part of the strategy note is there's a narrative. And again, sometimes I scratch my head. It's a lot of smart people, I think, participate in the bond market, but no one seems to understand it. The yield curve is destined to dip in. This is not complicated, but like, why do I have to explain this? Like, so if you look at the consumer, there's been a narrative, particularly last 2 months, that the consumer came into this trade war in like terrible shape and like, they're really weak and all this stuff. And it's like, look, like they're weak. They're weaker on an excess savings basis relative to a year, 2 years ago. They're weaker on the strength of a labor market basis, because 2 years ago we had a white hot labor market. Now we have a warm one, admittedly, but every other metric on the aggregate level, which is all that matters, we understand there's weakness in certain pockets of lower income deciles, and yes, credit card delinquencies have gone up to some extent, but all they've really done is mean reverted. And so when you actually look at hard data, what you see is not only is the consumer in a ridiculously stronger position than they were at the end of '07 before the GFC, when the consumer was in like the worst shape of all time, which doesn't surprise that many people, but relative to the end of 22, because remember, the narrative is like the consumer was like in great shape in 22 and great shape in 23, and now they're kind of like in terrible shape, which makes no sense. You've seen substantial improvement in metrics like debt to GDP, debt to disposable personal income in particular. Remember, the Fed hiked rates a lot, and yet debt service ratios are in better shape today than they were at the end of 22. So when you go through the metrics, it's not to say that the consumer is as strong because they've lost excess savings and the labor market is weaker. So I would definitely not push back too hard that like the consumer is not at least a little bit weaker. But if you look at aggregate metrics, the consumer is actually in better shape today than the end of 22. So and the point of all that is, again, and I know we'll get into it more, is that if you're expecting the consumer to just buckle because confidence has dropped, right? That's soft data, right? And it's always, believe what the consumer does, not what they say. Just like, in politics, it's, watch what the votes come back in, not necessarily the surveys. So far, so good. And again, all the hard data up until today, every hard data series still looks very, very good. So that's one of the reasons, even with this trade uncertainty, we think recession risk 1 in 3. Yeah, like maybe it's as high as 1 in 2, but it's certainly not a guarantee. And if the trade war gets rolled back, then again, damage has been done, no doubt about it. But we can quickly kind of move back to a period where economic expansion is almost a certainty. And then the last point I'll say there, Harrison, it's important, is again that one of the reasons markets have reacted as violently, and some people maybe extrapolate data incorrectly, is coming into the year there was no risk of recession. Like you couldn't figure it out. Like how, like, okay, China invades Taiwan, or there's another pandemic, and then you suddenly go from that to like, holy cow, like this is recession risk is a meaningful part of the probability distribution, which happened very, very rapidly.
Well, so then how is this shift, and how is this perspective on the strength of banks and consumers helpful potentially for investors?
Yeah. So again, I think when you're looking at allocating to any strategy, right, like we always say, whether it's anything with an E by it, public equity or private equity, or the C by it, public credit, high yield bonds, levered loans, private credit. The thing you always fear the most is a deep, dark recession repeat of '08. That still looks highly, highly unlikely. That being said, like we talked about before, in a weaker growth environment, you'll get less revenue and less EBITDA growth, which means your performance would not be as good as it would have been if this trade war never started. But it should still be certainly on a relative basis incredibly attractive. In the alts business, our biggest performance spreads are always in bear markets, like 22 or so far this year. In the dark days of the pandemic, we root for every other asset class because we want to complement those. But the times where we really outperform and shine for clients are in the darker moments for equities or bonds like we had in 2022.
Well, so then what are you've already spoken to some of these, but what are the areas where you're seeing potential opportunities in the alt space?
So it's really exciting. I mean, I think it depends on the strategy. We have a big platform from commercial real estate lending to, asset-based loans, middle market private equity. Within middle market private equity, there's primaries, secondaries, co-invest. And, so I'll give you a couple examples. So on the middle market private equity side, our expectation coming into the year was that we would continue to lean into co-invests pretty aggressively, because that's where you get the most juice, the most torque. We did expect slightly weaker growth, just from a standpoint of, as inflation came down, real was the same, less inflation. But that was the expectation. And we would continue to fade secondaries because prices had normalized. And all things being equal, you always get less growth from a secondary pool than you can in a co-invest or a primary. Well, okay, best laid plans of mice and men, right? So boom, here comes, this trade war. And what we've already seen is secondary pricing start to readjust downward. There's been many headlines of institutions that are once again looking to raise capital through the LP secondary market, where you have an investor and a private equity fund. They need liquidity. They sell at a discount. And then the other side of that is that, when you think of the expectations from private equity managers, broker dealer CEOs, and others, there was an expectation that the IPO market would come back very strong. We were always the most suspicious of that. We expected, LBOs to come back and private-to-private transactions and mergers. And yeah, the IPO market would come back. Maybe not quite as much as those folks were articulating, but that's obviously frozen. And will be frozen until we get through this unfortunate period of time. So what that means is, you have general partners and private equity firms that are under a lot of pressure from their institutions to return capital. And so GP secondaries or continuation funds have been the preferred route to do that when the IPO market is either closed or just not booming. So this could be the year where GP secondary volume strongly eclipses LP secondary volume, and we're able to find a lot of great investment opportunities. On the private credit side, so I was a little bit bummed coming into the year because I love asset-based loans. I mean, it's the coolest stuff we do, really unique, great risk reward. And fortunately, really since the end of 2022, we've been able to find opportunities where we could get equal or better return for less risk in asset-based loans. Usually in asset-based loans or asset-based finance, you sacrifice some return to significantly reduce your risk. And so I obviously mistakenly, not expecting some of these outrageous policy shifts, which are very counterproductive, thought that there would be less desire for corporate entities to bolster their balance sheet with excess cash if they're pulled up on the economy, their business, pro-growth reforms, either regulatory or an extension of the TCJ with some sweeteners kicked in. But fortunately, we continue to find those opportunities. And now I'm certain that they will continue, right? Which is, again, unfortunate, but from an economic standpoint, but from an opportunity standpoint, ABLs are very differentiating. And I think they're some of the most attractive risk reward in markets in terms of you're making a high single digit to low teens, sometimes higher return, and taking meaningfully less risk than not only unitranche corporate private credit, but also high yield bonds, levered loans, et cetera, et cetera. So those would be two areas. Can't talk about every vertical, but the thing to always remember is in pockets of dislocation and uncertainty, it's often when you find your best investment opportunities.
That makes a lot of sense, and it sounds like some compelling opportunities, and interesting to see what has remained constant from the beginning of the year to where we are now, and what you're seeing that's going to continue to be compelling, hopefully as we move into the future. Mm-hmm. Well, finally, as we wrap up the episode, it's the name of the show. and a great way to summarize our conversation. What's the takeaway you want listeners to have from our time together?
Yeah, so I think the first takeaway is this is a very difficult period fundamentally for some of the biggest winners from globalization. A, our trading partners. B, multinational corporations, including U.S. multinational corporations, which make up the bulk of the trading volume, the bulk of the investment volume. If you think of the path here, if we stay in this period of uncertainty, middle market private corporations in the U.S. are arguably the most insulated from that phenomenon and can still generate, we think, attractive revenue and EBITDA growth, even in a slower growth environment. So that'd be one. Two, that even though things have gotten darker, the U.S. economy is a service economy. It's very resilient. Manufacturing is a very small percent of GDP. There's been no deterioration whatsoever in the hard data yet, although the soft data surveys confidence have collapsed. So don't get carried away and fear the sky is falling and there's going to be this complete implosion. Stay the course. That's why you have asset allocation. Use this opportunity to make marginal changes like we talked about before, maybe peeling off some Russell, maybe peeling off some international exposure. So with that, thanks again, Harrison. You're the man.
Thank you. Well, for more on what evolving trade policy means for portfolio construction, read Troy's full strategy notes. The Galactic Mean Reversion Part 2, Trade Wars Are Not Good for S&P 500 Profit Margins, and the second note, What Should Investors Do Next? Examine Contributing Parts of GDP. You can find both notes on our Insights page at fsinvestments.com/insights. Thanks for a great conversation, Troy. Read Troy's full strategy note and get up-to-the-minute investment strategy, research, and more at fsinvestments.com. This episode was recorded at the FS Investments headquarters in Philadelphia's historic Navy Yard and in our New York executive office. It was hosted by Harrison Beck and edited and engineered by Aaron Sherman. Video edited by Melissa Vendetti. Special thanks to Ellie Zhang and Laura Coleman. Make sure to follow and subscribe to the Fireside Podcast wherever you stream. Thanks for listening.